Welcome to the Innovators and Investors Podcast. I'm Kristian Marquez, founder and CEO of Finstrat Management. At Finstrat, we provide CFO-led accounting, finance, and reporting services to assist clients monetize their business. Stick around to the end of the podcast and I'll share how you can be our next guest. Now on to the show. Hello, and welcome to another episode of the Innovators and Investors Podcast. I'm your host, Kristian Marquez, founder and CEO of Finstrat Management. Really excited because today we have with us Brian Parks, founder and CEO of Bigfoot Capital. Brian, welcome to the podcast.
Happy to be here. Thanks for having me, Kristian.
Yeah. So Bigfoot Capital, love to hear the investment thesis and your focus.
Yeah, sure. So we started Bigfoot 8 years ago, really with the express mandate to provide a differentiated capital offering to B2B software companies at a relatively early stage. So not pre-revenue companies that have some semblance of establishment to them, i.e. some product market fit. And so for us, that's companies with at least $2 million of recurring revenue. We think it's non-trivial to get a company to that level of revenue. Grand scheme of things, still quite a small business. And we think what we're trying to do is step back and say, hey, historically speaking, these B2B software companies, the only real debt option they've had available to them is pure play venture debt, which is very tightly coupled to raising venture equity, which is fine. But saying, all right, what about all those other companies that either choosing not to raise venture capital or angel money, or maybe they have done that, but they haven't done it very recently, right? If you're going to get venture debt, you probably have to have raised a round within the last quarter or two. And that just didn't really exist as a debt offering to B2B software companies when we started this company. There were a couple of groups doing it. And I'll tell you, rewind the tape, and where I grew up professionally was in lower middle market M&A. Lower middle market and none of that was tech. It was all kind of businesses, very broadly speaking, that had been around for a number of years, had raised some capital, had a capital structure. And again, none of it was venture capital. They may have had bank debt, they may have had mezzanine debt, they may have had private equity or not. We were helping those companies really achieve, in my view, what were very good outcomes. Enterprise value of anywhere from $100 to $500 million, where the people that had committed a lot of their time, effort, lives, livelihood to that business walked away with some really good outcome. And then I jumped into tech in 2010 as an operator, and there seemed to be very little of that. There was just such a focus on raising angel or venture money. And so that was a little bit foreign, and thinking, and I did that as well. I started a company. I was early at a few other companies, raising angel, raising venture, and that was really the only thing. So fast forward 7 years, and decided to start this business to bring that concept of a capital stack and structure that's a little bit more mature and grown up to these relatively smaller software companies.
And so, all right, so a whole bunch of stuff to unpack. Let's just start, if we can, with this concept of debt or non-dilutive capital. My sense is founders generally just think of price equity rounds and don't appreciate that there are other financing avenues available. So if you can dial us in for the Debt 101, that'd be a great starting point.
Yeah, and I think that's pretty true. So we're always trying to broaden the knowledge base for folks in terms of their capital options. Debt 101 for software companies, what are the true options? So I touched on venture debt, and I think a lot of people may be familiar with that moniker, but then may not really understand what it is. And what it is basically, again, a debt instrument product, a term loan attached to an equity raise. So you're a software company, you've raised a $10 million Series A financing. Great. Some venture debt provider, bank or non-bank, SVB, Bridge Bank, Comerica, whoever does it in the bank world, and there's non-bank venture debt funds will say, that's awesome. Here's $3 million to tack on to that to give you runway extension. So that 10 million is meant to last 18 months. Here's another 3 to get you 6 months down the road, just in case, whatever. That's the thing. And that's what the venture debt provider is trying to do, is bank the portfolio companies of venture funds, right? And so providing credit is one part of business for them. They get the deposits, they make money off of that. They may do the fund banking services, they make money off of that. They sell credit cards to the company, they make money off of that. So it's a holistic way of monetizing that. And what the expectation is that the next venture, that's the path you're on. You're going to, in 18 months, raise another venture round. They may upsize your facility, whatever. There's going to be more deposits for them. That's all fine if it's working that way. And that can be a nice capital product to have in your capital structure. So that's venture debt. if you don't have that fresh equity raise, or you're not on that path, that's not really a viable product for you. And once you fall off that path for whatever reason, either if you choose to fall off that venture path or you just aren't able to raise more venture money, that can put you in a little bit of a bind with that venture debt provider. You're probably going to look to get repaid. And it's worth noting that the way they size kind of their facilities is as basically a percentage of the equity round. Again, back to 10, 3, they may lend you a third, 25% to a third of your equity round. Whereas what we are, is the way we think of ourselves, ARR lender, annual recurring revenue. So we're really looking at your revenue, again, minimum of $2 million. And we're going to say, hey, we're going to lend you some percentage of that, which may be 25 to 50% of that. And folks that aren't doing pure play venture debt, and you may be bootstrapped as well. You may or may not have venture capital in the mix. Folks that are doing that will take that view. And there may be folks that lend up to 100% of your ARR up market. So there's a spectrum there. I'll get to, if you've raised venture debt and you fall off that venture capital path, you want to be very sensitive to how much you want to consider that, because anyone who's going to try to refinance you and help get you out of that position is oftentimes going to look at you lever you on a revenue basis. So you raised $10 million, but you only got, you took 3 million, but you only got to 2 or 3 million in revenue for whatever reason. It's going to be hard for someone to take you out, because they're basically going to have to lend you 100% of your revenue to take out that venture debt facility. And we've seen a lot of that over the past few years. So that's the course that you've got these AR lenders like us, you've got venture debt lenders, and then you've also got revenue-based financing, which is also looking at the revenue base. It's just basically a different way of repaying the loan. So it's a royalty. So you may get a revenue-based financing facility that basically says the way that's going to be repaid is a percentage of your cash receipts every year. There's no stated interest rate. It's an IRR-driven credit product, not to get too into the weeds. What we do and what some others like is a term loan. There's an interest rate. There's generally going to be some interest-only period where you're not paying as much, and then you start repaying the loan over time. We do a multi-draw concept to give you the ability to continue borrowing. I'll pause there because that's a lot.
No, that makes a lot of good sense. I would like to hit on due diligence next, but before we do, I think founders in our audience, I think they should know this exists. You point out, if you're on a venture path, we could probably devote an entire podcast to that as well. But just this idea of, hey, investors have investors of their own. They set return expectations, and there's generally a time frame associated with it. And so if for whatever the reason you cease to be on that time frame, lenders like Bigfoot Capital are just a great source, presuming the business is still growing or you have a degree of confidence around your recurring revenue to continue to finance your business's operations and take advantage of that growth. So all investors, whether they're equity or debt, are not only thinking of return, but they're also thinking about risk. And would love to hear how Bigfoot thinks about mitigating risk while you guys are doing your due diligence.
Yeah, for sure. So for us, the riskiest thing, Kristian, that we can do to a company is over-lever them. And so we're going to be very sensitive to that. And we may lose opportunities because of that. And I would just, counsel someone considering debt to not get, it's much like equity, any capital. Don't get enamored with a headline number. I think oftentimes the capital provider, equity or debt, wants you to take more and more because they've got to deploy capital and they've got a certain fund size, but you got to step back and be like, how much do I actually need with my plan? And what does that mean for me? What position may that put me in if I take more? So we're very sensitive to that. And I encourage folks to also be very sensitive to that. For us, from an underwriting standpoint, look, at the end of the day, these companies are pretty straightforward. They're not multinational, huge. There's no supply chain. There's small software companies. Predominantly, what we need to understand is the revenue profile, right? And what that really looks like. That is our primary source of repayment, and collateral is the primary way these businesses are valued from an equity standpoint to include acquisitions. It's the quality of the revenue. And so that takes some digging, and I mentioned Maxio earlier, and having products like that, having support you provide for these companies to really have a good revenue story and data quality is extremely important to show up with that if you're going to be diligenced by anyone. The cost structure is relatively simple. I think what we see is kind of 70% of the cost structure is people. And so we have to understand the hiring plan, of course, and what you're doing to manage that and how it makes sense. And then beyond that, the discretionary spend, what you're putting into sales and marketing and how efficient that is. And of course, we're going to look at all the standardized SaaS metrics and what have you. So there's nothing like overly nuanced there. We just have to be able to do that work. and understand it. And so I think in this market environment, and for us, we're not dissimilar from equity investors. And often it is akin to an equity underwrite, even though we're providing debt. But retention really matters. I think I've been fairly surprised recently of how poor gross retention is for a number of companies. It's very hard to grow a successful, frankly, software business if you don't have that core dynamic. And so I've almost been like, are we measuring this incorrectly? What is going on here? We're seeing some pretty poor gross retention. You couple that with not exceptional, not great growth, and you've got some fundamental issue. And we're really going to look at retention pretty closely and try to understand that, as is anyone allocating capital into software companies. Growth can vary. We have companies growing and scale dependent is also how's the burn relative to that, and how much capital have you raised and where you're trying to get. It's all interrelated, right? But we can step into companies that are growing 20%. Now, if you're a $5 million ARR company growing 20%, you're not going to raise the next venture round. That ain't happening. Could you be an add-on for some platform from a PE standpoint? Yeah. Could you be interesting to a strategic? Yeah. Could you cash flow the business? So there's options there, and there has to be a reasonableness from the operators of what they're going to achieve. And the capital structure that's already in place when we step in has to be aligned with that. So if you're a $5 million AR business growing at that profile that's raised $30 million, like $40 million, which there are a lot of those out there, probably not a great fit for us. We want to step in believing that all stakeholders in the capital structure can still have success, not just us as the senior lender, everyone, to include the common, right? That's what we're really trying to foster, are good outcomes. Rewind back to my lower middle market banking days. I'm like, hey man, like if companies have an appropriate capital structure and can sell for 30 to 300 million, if you look at the median M&A valuation for software companies, I think the last data, it's 70 million, right? Which is a lot of money if you still own a lot of that company. But oftentimes that level doesn't work for traditional venture capital investors, right? That's just not what they're trying to do. But there's only very few IPOs, as we're aware. There's a lot of unicorns that are hung, that are no longer unicorns. Where do they go? There's only so many acquirers that are able to write a check to buy someone for $500 million plus dollars. And so what we want to try to do is foster a lot of, good outcomes that can still, again, flow down to the common that are 8-9 figures. And we think our capital helps do that.
I mean, that's brilliant on a lot of levels. One, kudos to you for, seeing beyond just the immediate return of getting paid back on financing. But I also think, for the founders in our audience, this theme has come up before, this idea that investors, you're a professional investor and that you have investors of your own. And so you're thinking of, hey, how do I generate, not only do I provide liquidity to the market, which is extremely valuable, but then how do I create value in the long run, not only for our clients, but our investors as well. Yeah. I think the most sophisticated investors have a true appreciation that's the case. And hopefully podcasts like these reinforce that. SaaS metrics. So we can dig a little bit more onto due diligence. So I got a bunch of questions. So I heard gross retention. Would love to hear if there are any other metrics that you find that you hone in on. And then also kind of just thresholds or benchmarks, if you have them top of mind, as to what you use as a guide to say yay or nay.
Yeah, for sure. And maybe we'll circle back to the capital offering we have for folks allocating capital into software companies. We can touch on that. We can touch on the kind of the core value that I think is so overlooked by people building and running enterprise value. Let's all just think about enterprise value. So what are you trying to do with someone starting a company who's taking a ton of risk, your ultimate payday, you're probably underpaying yourself, and your ultimate payday is realizing enterprise value. So what you're trying to do is grow it, retain it, and ultimately realize it. How do you realize it? Generally speaking, you sell the company, right? You're probably not going to IPO, right? And retaining it is going to be very important. Again, if you're able to ring the bell and IPO, maybe you only need to own 5 to 10% of that company because it's some massive outcome. If you're not able to do that, but you're able to sell it for 50 million, let's just say, and you own 40% of that, you probably made just as much or more money as you made if you were that founder of that public company. So those are viable outcomes to achieve. You can grow a company to $5 million in revenue. I'm not saying you can get a 10x multiple. Maybe you get a 6x multiple and you still own 40%. That's a lot of money in your pocket as the person who started that company. Anyways, back to metrics. I have a soapbox that's pretty large that I can stand on. I have to always try to get myself off of that. Back to metrics. Yeah, for us, there's 4 high-level categories that we consider: the growth profile, the retention profile, the capitalization and efficiency profile, and then what we'd call the debt serviceable profile. Somewhat overlapping metrics, but also somewhat distinct metrics. Things we don't particularly care about or put that much credence into at this scale: LTV to CAC, not that important to us. LTV can be gamed. It's hard to know. Sometimes you don't have enough history or data. CAC payback, it's important. It can also be, a lot of companies we work with are enterprise software companies that it can be kind of hard to truly deduce that. We care about it. From capital, retention is really straightforward. We care about both gross and net, and we care about it at the revenue and the logo or customer profile from a gross standpoint. And frankly, we think retention can be masked. Poor retention and can be masked on a net basis. So it's really important that we look at it on a gross basis. From a capital efficiency standpoint, burn multiple is quite important in trying to understand that and what it looks like. Capital raised ARR, historically speaking, have you funded this company historically, and where are you relative to that? It's also quite important to us. And we're hearing a story that all of a sudden you're going to be very capital efficient, but you've raised 10x your ARR historically. Maybe you aren't going to actually shepherd your capital that way and execute. Yeah, man, we try to boil it down to probably 10 core things we really care about, rather than, we don't need 100 data points and some ridiculous algorithm that runs to underwrite. Again, at the end of the day, are relatively straightforward businesses.
And so when I'm said another way, a lot of objective metrics that can make arguably due diligence a little bit more black and white. That said, you're a bit unique amongst founder CEOs who are investing, and that you're also an operator. Probably consensus that founders and team have an invariable impact on a company's success. But debt's different than equity. What role, if at all, does a founding team play in Bigfoot's decision to finance a company?
Yeah, it's a pretty decent role, Kristian. And again, I say it's somewhat akin to an equity underwrite, because the qualitative aspect for us, definitely is a relationship. At any given time, we've got 15 to 30 companies in the portfolio, and company cycle out, they repay us, what have you. And so relationship really matters in who we're working with. And look, I mean, I've historically said it's 30% science, 70% art in terms of the underwrite. Again, it's pretty straightforward to, hopefully you can get a clean set of data and enough data to work with that you can fairly quickly synthesize that and understand it. The digging on really the team and the qualitative aspects, the product, the market, all of that is, a bit more nuanced. And I'd say the data and the performance are a derivative of that, but you really got to get to that level of interacting with the people running this business. And even in our own diligence process, post term sheet, we won't do it before we sign a term sheet. We are going to talk to customers. We are going to look to get the voice of the customer. We are going to look at the product. We are going to talk with other investors if they're in the mix, equity investors. We are going to talk with people on the board, right? We want to have a pretty holistic understanding of this company, because we are viewing it as, we're going to work with this company for a number of years and try to support them to the best of our ability.
Common characteristics or profile that you found with founders that are a good fit for Bigfoot over the years?
I think it's people that value their equity and that aren't just transactionally minded when it comes to capital, predominantly. And so in that, take the long view. They're just not, hey, I am interested in growing. I am trying to grow enterprise value here. I'm trying to do it in some probably reasonable format along the way. It's really just that. And I'd say most of the folks we end up working with have either been running their businesses for a while or are on not their first business. And not to be age biased, but they're probably about to turn 43. They're probably similarly aged or older, and they've got things to take care of in their life. And so they're very pot committed to these businesses, whatever percentage of that they still own at this point. So I think it's really that, and someone who's willing to engage and not, yes, we have an interest rate. And yes, everyone wants a lower interest rate, then we're going to be mid upper teens interest rate. But to step back and say, oh, okay, I understand, Bigfoot, that you're trying to make 1.5x on your money over 3 years. And I understand that it probably only makes sense to take this capital and for us to provide it if the company can generate and retain more value than that. So can you put that money to work and generate 10x? Can you generate 2.5x, 4x? The more the better. You keep all of that. And that comes back to the enterprise value concept. Why are you going to try to sell that success if you have that machine to someone else. No, you retain it. Yeah, we need to this gets back to our own, what we do. And it's not all my money. Some of it is, but it's other people's money. Like, we're trying to deliver them a good return that's commensurate. And we don't take any of the upside. We've never taken a warrant. We get paid interest, and we in turn pay interest basically to people. And that's worked out really well. And we've been able to see a lot of good outcomes, thankfully, which is what we're trying to do, where companies are able to grow meaningfully, generate much more enterprise value than they're paying us in interest, and then either continue working with us or move on to something else, which is great.
I love it. I definitely have found that there are founders who seem to be a bit more successful because they can see the big picture and appreciate that when you're taking other people's capital, it's a different set of expectations. Switching gears a little bit, if I were to ask you to now put your founder hat on and look at the evolution of Bigfoot over the last 8 years, key lessons learned or anything that really the business has changed as it's matured?
Oh, that's a great question. I'd start with saying I feel as if we've stayed pretty true to our knitting and the whole reason we started this company and our whole approach to the market. I do believe that. So while we may have moderately moved up market from where, like, we don't write $250,000 checks anymore, and I think that, but we haven't raced out of our segment of the market. So we're still very comfortable playing where we play. Probably our minimum check now is $750,000, which is still quite small. We will write a check as small as that up to 5 million. We're not saying that we got to write $10 million checks, right? So we've moved up a little bit. We've stayed pretty true. We still only do B2B software. It's not only SaaS. A lot of it is, or subscription, but other business models. We still work across the capital spectrum from bootstrap to venture backed, a broad array of types of companies and sectors. All that is still the case. And we've still never taken a warrant. We're still trying to help people preserve equity and, again, grow, retain, and realize enterprise value. So we've stayed fundamentally sound there. So what has changed? The way we've oriented our own capital structure has changed over time. We started with only retail high net worth capital and deploying capital on behalf of those folks. We've brought a couple of institutional partners into the mix over time as we've grown and as we built our track record. That's all good and well. Frankly, those different forms of capital come with different expectations and requirements. So we continue to have both of them in the mix and like to have both of them in the mix. I think our focus, it comes back to taking the long view. It's what are we really trying to do? We're trying to run a fundamentally sound lending business in a sector that we like to serve and do it. I think about the P&L of our own business, and I'm the majority owner, and I'm trying to do the exact same things with my business that I'm trying to help other people do. Grow, retain, ultimately realize enterprise value. I don't know. That's kind of it. We haven't changed all that much, I guess. We've learned a lot. We're constantly trying to improve our own internal approach to, managing risk for these types of opportunities and how we think about how we interact with our companies and support them. But
understood. So then let's talk, if we can, talk a little bit about anticipating the next 4 years. So for benefit of our audience, we're recording this mid-December 2024. It's post-election, and we're going to have a Trump administration, arguably pro-business. We also have a backdrop of higher interest rates. So if everyone, I'm sure, is aware, back in Q1 of 2022, the Federal Reserve removed the U.S. from what was effectively a zero interest rate policy, and now rates are the highest that they've been in 20 years, albeit the Fed, I think that it was a 25 basis point cut last month. Then I think they were pointing at a weaker jobs report and maybe a little bit more tepid inflation. All of that said, what's your take when you look across the landscape from the perspective of interest rates, market, and how that may influence investing decisions?
Oh my gosh. So I'll just separate the macro and the micro, which are absolutely related. When I say micro, I just mean at the individual company level and folks being able to control what they're able to control to the greatest of their ability. None of us can control the macroeconomic environment. We're all impacted by it. Interest rates, right? As you mentioned, the most rapid escalation of interest rates, I think, in 40 years and sitting at call it 20-year high. Been challenging for everybody. So I think everyone at this point is cognizant that has happened. The effects of that have rippled through the private markets on the equity and debt side, and starting with the public markets. Now, I think what I've heard most recently, maybe we get another 25 basis point reduction in interest rates, but then maybe there's a pause. There is not some rapid reduction in interest rates that's magically happening. We could be sitting here this time next year and we've come down 75 basis points. We haven't come down 300. Do not know. It's really hard to say, right? Inflation has been materially moderated. It's still slightly above the Fed's target of 2%. And then it's a matter of, we shall see, right? There's the conversation around tariffs. Are tariffs actually going to be implemented? Is that actually going to do something to the detriment of inflation reduction? Don't know. How's the Department of Government Efficiency going to come in and what's that going to look like? So it's anyone's guess. I think and then there's, I'll step back and say within software, right? What's happening within B2B software budgets? Large reallocation seemingly to AI. So money continues to be spent on software and cloud products and what have you, but it still there has to be really good ROI justification. So there was a gorging of software done over COVID. We've certainly seen, you've seen, businesses have felt the whiplash back from that of why did we buy all this software? What are we doing with all of these things? We need to reduce the seats, what have you, which has made it really challenging from a growth and retention standpoint for the types of software companies we work with and the types of software companies you work with. So I think, and so that's the macro impacting the micro. And a lot of that, unfortunately, is frankly outside of the control of those software companies. Not all of it, and they shouldn't be absolved of having poor retention. You can't just hand wave it all away. And that was involuntary churn. There's nothing you can do about it. Yeah, probably not. But I don't personally foresee an environment where growth gets easier for the standard software company. I would love for that to be the case. Maybe budgets open up a bit, but I just think there's still we don't have certainty at the macro level. So I don't know. I wish I had a better answer than that. I don't know. I think there's still so much capital. There truly is dry powder out there in the equity and credit markets that, for folks like that focus on software companies, that is eager to be deployed. That said, there is a supply-demand quality supply imbalance, right? So there's a lot of demand and capital sitting there that, again, needs to be deployed or just returned to LPs. And so we couldn't find any good opportunities. But you can't magically snap your fingers and have much better supply, right? And I think a lot of capital, both equity and debt, is there are good opportunities out there, and then those good opportunities, it's like sharks. Everyone comes to them and they get bid up, and then is it still a good opportunity? Yeah,
it's a great point. I've gone back and forth myself as to whether or not it's more higher valuations that came out of the pandemic, or a Federal Trade Commission that's just anti-merger, that is put the brakes on activity. And I guess a positive tailwind is Lena Khan steps out and they get replaced with someone, sure, maybe they're a little bit more tough on tech, but are open to M&A. Maybe that releases the pressure and we see a bit more.
That's activity. That's a good point. Yeah, absolutely. We were looking at this at a team, funnily enough, about 10 minutes before how many tech IPOs were there? And let's just say there's still 1,200 unicorns. At one point there were. I don't know how many of those are actually still unicorns or ultimately what they realize. Again, they haven't really realized the value yet. They've been marked up on paper and they're a unicorn, but there's not been a realization. I think there was 120 something in 2021. Maybe that's right. And there's 20 in 2022. And there's been 3 or something this year. So obviously that IPO window needs to open. Totally agree with you that hasn't been the most favorable from a regulatory standpoint environment for that. And so hopefully that does happen. And then it's, okay, how does that flow down? How does that go into the release of equity capital at what valuations at the earlier segments of the market? Is there going to be a glut of AI opportunities that everyone wants AI, but is this going to be a total glut of those opportunities? Do those get bid up? Do we just get back? All this stuff's cyclical. Everyone's got short memories, right? And everyone wants to deploy capital. Companies want capital. So what kind of behavior does that drive?
I'll remain optimistic that the activity picks up with the next.
I love that.
Brian, it's been a great podcast. Before we wrap up, 2 questions. One a bit fun, the other one a little bit more introspective, but I gotta know, why Bigfoot? Where'd the name come from?
Yeah, it's a bad pun. Not some branding guru, but I think it's been a fun brand, and it's towards the beginning of the alphabet, which I think is also helpful. But one of the first financings my partner Pete and I did, which actually predated Bigfoot, was an acquisition, one software company buying another. So 2 SaaS companies. We started calling it a SaaS acquisition. And then we're out here in Denver, and I was coming up, left the company where I actually did that deal and started Bigfoot and was Sasquatch. Okay, I was driving through the mountains with another buddy of mine, and it led to expand your footprint. Capital shouldn't be elusive. Oh, okay, Bigfoot. That was it, man. It started with a bad pun.
I love it. It's fun subject. Obviously, a lot of debate whether or not there's really Bigfoot. I guess depends who you talk to, but I love it.
Oh, man. Yeah, I have not seen a Bigfoot, although there is a Bigfoot museum about 45 minutes from our office, which I haven't been to. I should visit.
Is there really?
Run by fanatics, I'm sure. But...
Oh my gosh. Yeah, I had a friend once who tried to convince me to go on a camping trip in British Columbia to some town that says they hear them all the time. And I was like, yeah, I'll get back to you.
Yeah.
Introspective. As you look back over the last 8 years, would love to know what advice you'd give yourself on day zero that you've accumulated.
Oh man, don't have 2 kids, don't go through a pandemic, don't go through a tech recession while running a tech lending business.
It's a lot.
Just kidding. I'm very glad I had 2 kids. I could have probably foregone the whole pandemic and tech recession.
They won't hear.
Yeah, man, I think it's really in this somewhat a bland, it's all about the people, right? It's all about the people you surround yourself with. And for us, multiple constituencies. Who are we working with that we've raised capital from at the institutional level, the retail level? Do we like those people? Do they understand what we do? Do they trust us to do what we do? Who are we providing that capital to? Are they going to be good stewards? Do they value what we do? Who's the team we build here? Super important. It really comes down to the people and the relationships, man, at the end of the day. Again, we can run financial models. We can do those things. That's all fine. And we can synthesize data and we enjoy doing those things. Of course, we have to do those things. It's the people. It's the people, right, that are going to make, if you're committing, and I'm 8 years into this, as is my partner, as is some of our team, if you're committing to that, you got to be able to enjoy it. And it's going to be the people that you work with and are surrounded by that help you enjoy it.
100% agreed. I think it's great insight. Couldn't agree more.
I think at one point I did not appreciate that. Even when I started my first company, I remember sitting at one event, an angel event. There's this angel association out here. And I was a founder at the time. What's the most important to you, angel investors? The people, the team. And I was like, really? Is that really the most important? I just did not appreciate that at that time, frankly. And you get more experience, you work with more people, and then you really realize how important it is to really surround yourself with really good people.
100%. Yeah. So as a founder myself, I've had a similar experience. If I think about one of the assets in an early stage company, it's yes, your product, your service, and the problem that you're solving are invaluable, but invariably at the end of the day, you got to execute. And I like to describe it as, what's an A player to me? They're smart and effective. People that you can rely on to get the job done without necessarily having to ask them or at least give them minimal guidance, because there's just so many things to do. So fantastic. Brian, great podcast. If there are any founders or investors who'd like to get a hold of you, where can they find you?
Yeah, we're at bigfootcap.com. I am on LinkedIn, Brian Parks, CFA is how I show up. And then you can check out our newsletter, which I need to do a much better job of being consistent with, at bigfootcapital.substack.com. So we're pretty easy to reach on the website.
Fantastic. Let's get signed up for that newsletter audience. Brian, thank you so much. It's been another episode of the Innovators and Investors Podcast. I'm your host, Kristian Marquez, founder and CEO of Finstrat Management. Thank you. Kristian Marquez here. Thank you so much for listening to the Innovators and Investors Podcast. If you're a successful founder or an investor who would like to be on the podcast, please visit podcast.finstratmgmt.com/podcast-guest. If you've got something out of this interview, please share this episode on social media. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors Podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.